The pros and cons of different business organizations. The different forms of business organization include sole proprietorship, partnership, and corporation. The sole proprietorship structure has the benefit of simplicity and control, but the drawback of unlimited liability. So simply, there are a few ways to set up a business, like being on your own sole proprietorship, working with others partnership, or becoming a corporation. When you run a business all by yourself, it's simple, and you get to make all the decisions. But the problem is, if things go wrong, you have to take care of everything, and you might be responsible for a lot of debt. Why is this important? It's crucial to know the pros and cons of different ways to do business so you can choose the one that fits your needs and goals. Exploring the advantages and disadvantages of partnership structures in business. The partnership is a type of business structure open to businesses run and owned by two or more entrepreneurs. It is easy to form and has flexible decision-making, but the partners are personally liable for business losses. Limited partnerships and limited liability partnerships mitigate some disadvantages. So simply, a partnership is when a business is owned and run by two or more people working together. It's simple to set up, and the people in the partnership can make choices together. However, the big downside is that the partners are personally responsible if the business loses money. There are some types of partnerships, like limited partnerships and limited liability partnerships, that help reduce this downside. Why is this important? Well, partnerships are a way for people to work together in business, but it's essential to know the good and bad parts, and to think about whether it's the right choice for your situation. Insightful advantages and considerations of limited liability companies. Limited liability companies, LLCs, protect owners from personal responsibility for business debts or liabilities. They have features of corporations and partnerships, with flow-through taxation to members. Members can be individuals or entities, but banks and insurance companies cannot form LLCs. They require articles of organization to be filed with the state and may elect corporate taxation. Creditors may pursue members if fraud is detected or reporting requirements are not met. So simply, LLCs are like a shield that keeps the people who own them safe from being personally responsible for the company's debts. They're a mix of corporations and partnerships, and the money they make goes straight to the owners for taxes. People or other businesses can be the owners, but banks and insurance companies can't do this. To create an LLC, you need to send some papers to the state, and you can choose to pay taxes like a corporation if you want. But remember, if you try to trick people or don't follow the rules, your personal things can still be at risk. Why is this important? It's a way for people to do business and protect their personal stuff, but you need to be honest and follow the rules to keep that protection. The process and advantages of forming an LLC. From paperwork to limited liability, the documents required to form an LLC include the names and addresses of members, registered agent, and statement of purpose. Articles of organization are filed with the state, along with a fee, to create an LLC. Paperwork and fees must also be submitted at a federal level to obtain an EIN. The primary advantage of an LLC is limited liability for its owners. However, LLCs may have to be dissolved upon the death or bankruptcy of a member, and they are not suitable for launching a publicly traded company. LLCs and partnerships are both allowed to pass through profits to their owners, but LLCs provide limited liability. A business continuation agreement can ensure smooth transfer of interests when an owner leaves or dies. So simply, when you want to create an LLC, you need to fill out some forms with information about the people involved and what the LLC will do. These documents, like who the members are, where they live, and what the business is about, are sent to the state along with a fee. You also have to do some paperwork and pay a fee to get an EIN number at the federal level. The best part about having an LLC is that it keeps you from being personally responsible for the company's problems. But there are some downsides too. If one of the members dies or goes bankrupt, you might have to end the LLC. And if you want to make a big company that's traded on the stock market, an LLC isn't the right choice. This is important because it shows a way to protect yourself when you run a business. But it's not right for every kind of business. You have to think about what's best for your situation. The advantages of limited liability companies, simplified taxation and asset protection. Limited liability companies, LLCs, offer advantages such as simplified taxation and protection of personal assets, making them the most common type of business in the U.S. Examples include Alphabet, PepsiCo, and Johnson & Johnson. LLCs are taxed differently than corporations, with profits passed directly to investors rather than being taxed twice. So simply, LLCs are a popular way to do business, like big companies such as Alphabet, PepsiCo, and Johnson & Johnson. They're liked because they make taxes simple and keep your personal stuff safe. With an LLC, you don't pay taxes twice like some other types of companies. Your profits go straight to you, and you only get taxed once. Plus, if something goes wrong with the business, your personal things, like your car or house, are usually safe. This is important because it shows that there are ways to run a business that make it easier and safer for the people who own it. It's a smart choice for many businesses. The pros and cons of the corporate structure. The corporation is a legal entity created by individuals or entities to conduct business. It is a separate entity from its owners, who are known as shareholders. The corporation offers limited liability to its shareholders, which means they are not personally liable for the company's debts and obligations. The corporate structure has some disadvantages, such as the requirement for annual reporting and potential double taxation. However, it also has advantages, such as ease of transferability of ownership and protection of personal assets. S corporations are a type of corporation that passes income, losses, deductions, and credit through to shareholders for federal tax purposes, resulting in taxation similar to that of partnerships. Agency conflicts can occur when the incentives of the agent, such as a company's management, do not align with those of the principal, such as the shareholders. So simply, a corporation is like a business that's its own separate thing, not just owned by people. The people who own it are called shareholders. One good thing is that shareholders don't have to pay for the company's debts. But there are some not so good things, like having to report things every year and sometimes paying taxes twice. However, it's easy to sell or transfer ownership, and your personal stuff is protected. Corporations are a special kind of corporation that helps with taxes. They make it so the owners get taxed more like they're in a partnership. The important part is that sometimes the people running the company agents don't always want the same things as the owner's principals. This can cause problems, and that's why it's important to think about how a company is set up and run. Bridging the gap, understanding the principal-agent problem and agency costs in corporate governance. The principal-agent problem in corporate governance refers to the difficulties in motivating managers to act in the best interests of shareholders due to asymmetric information and different objectives. Agency costs arise from contracting costs, divergence of control, and conflicts of interest between stakeholders. So simply, the principal-agent issue in businesses is all about the challenge of getting managers to make decisions that benefit the shareholders. This is tough because managers often have more information than shareholders and might have different goals. Agency costs happen because of the expenses related to making agreements, differences in control, and conflicts of interest among the people involved in the company. Why is this important? It matters because when managers and shareholders don't agree, or when managers don't work in the best interests of shareholders, it can cost the company money and affect how well it does. So understanding and addressing this issue is crucial for a company's success. Navigating conflicting interest stakeholder objectives in corporate dynamics. Conflicts of interest can arise between stakeholders in a corporation, such as managers, shareholders, and bondholders, due to differences in their objectives and rewards. So put simply, disagreements can happen between different groups of people involved in a company, like the managers, the shareholders who own the company, and the bondholders who lend money to the company. These disagreements happen because each group has different goals and expectations. This is important to understand because these disagreements can affect how the company operates and its success. When everyone's interests are not aligned, it can lead to problems, so it's essential to manage these conflicts to make sure the company works well for everyone involved. Navigating agency costs. Shareholder rights and corporate governance. Managers and shareholders may have different objectives, leading to agency costs. Conflicts of interest can arise when managers engage in self-dealing, empire building, or risk-averse projects. Contemporary discussions focus on respecting shareholder rights and improving corporate governance through disclosure and transparency. In simple terms, when people who own a company shareholders and the people who run the company managers have different goals, it can create problems. These problems can happen when managers do things that mainly benefit themselves, like making risky decisions or trying to make the company bigger just for their own benefit. To solve these problems, people are talking about two things: making sure shareholders have the right to know what's going on in the company and making sure the people running the company do it in a fair and honest way. This is important because it helps make sure everyone's interests are considered and that the company runs better. The conflicting interests of shareholders and bondholders balancing risk and security. The text discusses the differences between shareholders and bondholders and how their interests may conflict. Shareholders prefer riskier projects with higher potential returns, while bondholders prioritize safer strategies to ensure repayment of their investment. Shareholders have voting rights and may receive dividends, whereas bondholders do not have voting rights but receive interest payments regardless of profit. Bondholders may use contracts to limit risky projects and increase the cost of capital for the company. So simply, two different groups of people who invest in a company: shareholders and bondholders. Shareholders like to take more risks because they want a chance to make more money. Bondholders, on the other hand, like to play it safe to make sure they get their money back. Shareholders get to vote on company decisions and might get a share of the profits, while bondholders don't get to vote but get paid interest regularly, no matter if the company is making a profit or not. Sometimes bondholders use agreements to stop the company from taking big risks and make it more expensive for the company to borrow money. Why it's important? This is important because it shows how different kinds of investors in a company want different things. Shareholders want more reward, so they take more risks, but bondholders want safety. Understanding this helps us see how companies have to balance these interests to make everyone happy and keep the business running smoothly. Achieving long-term profitability through strategic financial management. The text explains that strategic financial management is about creating profits for the business over the long run and involves managing finances with a long-term vision in mind. It also discusses how financial management varies by company, industry, and sector, and involves understanding and controlling the company's assets and liabilities. So simply, this text is all about making sure a business can make money for a long time. It means being really smart about how you handle your money with an eye on the future. The text also says that how a company deals with its money can be different depending on what kind of business it is and what part of the economy it's in. It's all about knowing and taking charge of what the company owns and owes. Why it's important? This is important because it shows how important it is for a business to plan for making money in the long term. How a company manages its money can vary, and understanding this is crucial for a business to succeed over time. It's about being smart with your finances and making sure you're set up for the long haul. Strategic financial management balancing trade-offs and stakeholder impact. The text discusses the importance of strategic financial management for companies, including the elements involved, such as planning, budgeting, and managing risk. It also highlights how companies need to make short-term versus long-term trade-offs when making financial decisions, and how these decisions may impact different stakeholders. Finally, the text explains how financial management strategies can vary based on industry and sector. So simply, this text talks about how important it is for companies to plan their money carefully. It involves making budgets, dealing with risks, and making decisions about money. Sometimes companies have to choose between what's good for them right now and what's good for the future, and this can affect different people involved with the company. The text also mentions that how companies handle their money can be different depending on the type of business they are in. Why it's important? This is important because it explains how companies need to be smart about their money to be successful. They have to think about the short term and the long term and how their choices affect the people connected to the company. Different types of businesses also have different ways of managing their money. Understanding this helps us see how financial management can be a big deal for businesses. The significance of strategic financial management for long-term success. Strategic management is crucial for a firm's long-term success as it sets targets and guidelines for achieving them despite challenges along the way. Financial management often plays a key role in strategic management, involving cost reduction, risk management, and budgeting. Ultimately, the goal of strategic financial management is to ensure that long-term goals are met. Valuation is a fundamental analysis tool used in financial management to estimate the worth of a business or firm, and it depends on the reliability of the firm's financial statements. Financial management focuses on the practical significance of financial numbers, aiming to create value and agility through resource allocation. So simply, having a smart plan for the future is super important for a company to be successful in the long run. This plan helps set goals and shows how to reach them, even when there are obstacles. Money management is a big part of this plan. It's about things like saving money, dealing with risks, and making budgets. The whole idea is to make sure the company reaches its long-term goals. To do this, they use a tool called valuation to figure out how much the company is worth, and this depends on how trustworthy the company's money statements are. Money management is all about making the numbers work in a way that adds value to the company and makes it flexible with how it uses its resources. Why it's important? This is important because it explains how a company's money plan is a crucial part of its overall strategy for the future. It's not just about dealing with numbers, but making sure the company can grow and be ready for challenges. Understanding this helps us see how financial management can shape a company's long-term success. Balancing shareholder wealth and stakeholder impact, the dilemma of financial management aiming to increase shareholder wealth by paying dividends and causing market value to increase is a goal of financial management. The idea of maximizing shareholder value is related to the idea of maximizing market value, which is the price at which an asset would trade in a competitive auction setting. However, the sole focus on shareholder value has been criticized for its potential negative impact on other stakeholders and long-term shareholder value. So simply, the main job of financial management is to make the owners of the company shareholders richer by giving them some of the company's profits and making the company more valuable. They call this maximizing shareholder value. It's like trying to get the best price for something if you were selling it in a big auction. But some people say that only caring about the shareholders can be bad for other people connected to the company and might not be great for the company's long-term success. Why it's important? This is important because it's about how companies make money and who benefits from it. Should they just focus on making the owners rich, or should they also think about how their actions affect others and the company's future? This can affect how businesses are run and their impact on everyone involved. Understanding this helps us see different ideas about what's most important in business. Balancing stakeholder interests and shareholder value, the dilemma of financial management. The goal of financial management is to maximize value for all stakeholders, including shareholders, while avoiding harm to any group. The Anglo-American model emphasizes shareholder value maximization, while some European countries recognize other stakeholders in corporate governance decisions. Proponents of stakeholder considerations argue that attention to other stakeholders can enhance outcomes for all, while others argue for maximizing value without harming stakeholders. So simply, the main job of financial management is to make sure everyone involved, like shareholders and other people connected to the company, gets the most out of it. This includes making money for the owners without hurting anyone else. In some places like the USA and the UK, they mostly focus on making money for the owners. But in some European countries, they also think about other people connected to the company when making decisions. Why it's important? This is important because it's about how businesses should be run. Should they care a lot about making money for the owners, or should they also think about how their actions affect other people? It can shape how companies operate and impact society. Understanding this helps us see different ideas about what's most important in business. The stakeholder concept and maximizing value, a holistic approach to financial management. The financial crisis of the late 2000s highlighted the potential of companies to harm other stakeholders while maximizing shareholder value. Some argue that businesses should consider other stakeholders, like the environment, and that a holistic view can enhance outcomes for all involved. Others argue that stakeholders, even if not considered in business decisions, should not suffer harm. The goals of financial management include maximizing value without harming shareholders, and the stakeholder concept is associated with corporate governance. The total value of a company is calculated by multiplying the number of shares outstanding by the price per share. So simply, during the financial crisis in the late 2000s, some companies were so focused on making money for their shareholders that they ended up causing problems for other people and the environment. Some people think that businesses should think about everyone affected by their actions, not just the shareholders. This way, everyone can benefit. Others believe that even if businesses only think about their shareholders, they shouldn't hurt other people. Why it's important? This is important because it raises questions about how companies should operate. Should they only care about making money for their owners, or should they also consider the well-being of others and the environment? This can affect how companies are run and how they impact society. Understanding this helps us see the different views on what businesses should prioritize. Innovative liquidity measures by Federal Reserve in response to the financial crisis. In response to the financial crisis, the Federal Reserve innovated in its provision of liquidity to financial markets beyond traditional tools, such as providing liquidity to non-bank financial institutions and buying large amounts of longer-term securities to ease financial conditions. So simply, when the financial crisis happened, the Federal Reserve did some clever things to help out beyond the usual ways they give money to the financial system. They started giving money to non-bank financial institutions and bought a lot of longer-term investments to make things easier in the financial world. Why it's important? This is important because it shows how the Federal Reserve got creative to fix the financial crisis. They went beyond their usual methods to make sure the economy didn't get worse. Understanding this helps us see how central banks can adapt and come up with new ideas to handle tough financial situations. Adapting liquidity facilities. The Federal Reserve's response to the 2007-8 financial crisis. The financial crisis of 2007-8 led to a breakdown in funding markets, making it difficult for households and businesses to borrow. The Federal Reserve had to adapt its liquidity facilities to address these strains, lending dollars to other central banks and providing discount window credit to banks. So simply, during the 2007-8 financial crisis, it became really hard for regular people and businesses to borrow money because the usual places where they get it were broken. So the Federal Reserve had to change how it helps in this situation. They started giving money to other countries' central banks and lending money to regular banks. Why it's important? This is important because it shows how the Federal Reserve adjusted its methods to make sure people and businesses could still borrow money during a tough financial time. It helped keep the economy from getting even worse. Understanding this helps us see how central banks can be flexible and creative to deal with financial crises. The Federal Reserve's emergency measures during the financial crisis addressing strains in short-term financing markets. The Federal Reserve had to take emergency measures during the financial crisis as the strains in short-term financing markets were severe. It created a range of liquidity facilities to meet the funding needs of non-bank market participants, including primary securities dealers, money market mutual funds, and other users of short-term funding markets. This was necessary because financial markets have evolved, with securitization playing a major role. Banks became dependent on liquid markets to distribute loans, and some of these loans were sold to off-balance sheet entities with liquidity guarantees provided by the banks. When securitization markets collapsed, the Federal Reserve had to step in to provide liquidity. Its actions were legal and economically sound, based on Walter Bagehot's principle of lending early and freely to solvent institutions at a penalty rate and against good collateral. So simply, during the financial crisis, the Federal Reserve had to do some quick and unusual things because the short-term money markets were in big trouble. These markets help banks and other financial players get the money they need for daily operations. The Fed made some special programs to give money to non-bank players, like money market funds and securities dealers, who were also in trouble. Why it's important? This is important because it shows how the Federal Reserve had to step in and help non-banks when the usual financial systems were falling apart. It happened because the way banks were doing things changed, and they relied on markets that got shaky. The Fed's actions were in line with a famous idea that says central banks should give money to healthy banks when things go wrong, but at a higher cost and with good collateral. Understanding this helps us see how central banks can prevent financial crises from getting worse. The role of central banks in addressing the financial crisis. The financial crisis in 2007 to 2008 led to a liquidity crisis in the banking system, which the Federal Reserve addressed by providing emergency liquidity facilities. These facilities helped to prevent a more severe economic downturn, but also raised questions about the appropriate role of central banks and fiscal authorities in stabilizing the financial system. Studies suggest that the emergency facilities helped to improve financial conditions and supported economic activity. So simply, in 2007 to 2008, there was a big problem in the financial world, and the Federal Reserve, the Fed, which is like the money boss of the United States, stepped in to help. They gave the banks some extra money to keep things from getting even worse. This made things better, but it also made people wonder if central banks like the Fed should be doing this kind of stuff. Some research shows that what the Fed did helped the money situation and the economy. Why it's important? This is important because it shows how central banks like the Fed play a crucial role in keeping the financial system stable during tough times. It also raises questions about how much power they should have in dealing with these situations. Understanding this helps us see how these actions can affect the economy. Strengthening funding markets and collaboration lessons learned from the financial crisis. The Federal Reserve's actions during the financial crisis included lending to non-bank financial institutions, foreign central banks, and providing liquidity swaps. These actions helped to stem the runs on money market funds and other non-bank providers of short-term credit. The funding markets remain vulnerable, as seen by the recent reemergence of strains in U.S. dollar short-term funding markets in Europe. The lessons learned from this experience include the need for the Federal Reserve to have authority to lend against good collateral to other classes of sound, regulated financial institutions, and to have a collaborative relationship with the institution's supervisor to ensure conservative liquidity policies. So simply, Federal Reserve, which is like the money manager for the United States, did some things to help during a big money crisis. They gave money to places that weren't banks, including foreign banks, and they helped with short-term loans. This stopped people from panicking and taking their money out of some funds. But even though things got better, there are still some problems with short-term money markets, especially in Europe. This text says that the Federal Reserve needs to be able to give money to other good financial institutions and work closely with their supervisor to make sure they have enough money. Why this is important? This is important because when there's a big money problem, it can cause a lot of trouble. The Federal Reserve's job is to make sure things don't get too out of control and that money keeps flowing smoothly. It's like being a firefighter when there's a financial fire. Navigating the dual challenges providing liquidity and overcoming stigma during a financial crisis. The financial crisis highlighted the need for central banks to have the ability to provide liquidity to troubled institutions, but also the need to avoid stigma around accessing such facilities. The Federal Reserve responded to the crisis by rapidly reducing interest rates and taking other steps to ease financial conditions, while also communicating clearly about its intentions to keep rates low for an extended period. So simply, this text is about how central banks, which are like the country's money helpers, had to do two things during a money crisis. First, they had to give some extra money to banks and companies that were in trouble. But they also had to make sure that these banks and companies didn't feel embarrassed about asking for help. The Federal Reserve, which is like the money manager for the United States, did two things to help during the crisis. They made it cheaper to borrow money, and they talked to everyone about their plans to keep the cost of borrowing low for a long time. Why this is important? This is important because during a money crisis, it's important to help banks and companies that are struggling. But it's also important to make sure they don't feel embarrassed about asking for help. It's like when a friend helps you with your problems and you don't want to feel embarrassed about it. The Federal Reserve's measures to stimulate economic recovery during the financial crisis. The Federal Reserve used various methods to ease financial conditions and encourage spending during the financial crisis. They lowered short-term policy rates, purchased longer-term securities, and supplied reserve balances to the banking system. These actions helped reduce the cost of borrowing for households and businesses while maintaining price stability. So simply, this text talks about how the Federal Reserve, which is like the money manager for the country, did some things to help the economy when things were really tough. They did three main things. They made it cheaper to borrow money, they bought stuff to help the economy, and they gave more money to banks. These actions made it easier for regular people and businesses to get loans without having to pay a lot of extra money. It also helped to keep prices from going up too much, which is important to make sure money is worth the same. Why this is important? This is important because it's about how the people in charge of the country's money helped the economy when it was in trouble. It's like when someone helps you when you're sick. It makes you feel better and helps you get back on your feet. The impact of the Federal Reserve's language and asset purchases on interest rates and market dynamics. Market participants interpreted the Federal Reserve's characterization of the federal funds rate as likely to remain low for an extended period as stronger than previous language about remaining low for some time. However, expectations about exiting the zero interest rate policy still react to incoming economic information. The effects of large-scale asset purchases are less well understood, but studies suggest they push up asset prices and lower interest rates. The effectiveness of these purchases is hard to quantify, and the large volume of reserves created may have unintended consequences. So simply, this text is about how the people who run the Federal Reserve talk about interest rates and buy assets to help the economy. When they say that interest rates will stay really low for a long time, it makes the people in the market think it's a strong promise. But even when they say this, it can change if they get new information about the economy. They'd also buy a lot of stuff assets to help the economy. It's like giving a boost to the prices of things and making interest rates lower. This can help the economy, but it's a bit tricky to know exactly how well it works, and sometimes it can have unexpected results. Why this is important? This is important because it's about how the Federal Reserve's words and actions can change how much we pay for loans and how the economy works. When they do things, it can help us buy things more easily and keep the economy going. So it's like making sure the money engine runs smoothly. Reevaluating monetary policies, the Federal Reserve's inconsistent actions and inflation concerns. The Federal Reserve's actions during the financial crisis have been inconsistent with simple monetarist theories, as banks have not increased lending and spending despite extra reserves. Inflation expectations are also a concern as the Fed buys more assets. The Bank of Canada has recently revised its time commitment based on changing circumstances. So simply, this text is about how the people in charge of money, they're called the Federal Reserve, have been doing some things that don't quite fit with the usual money rules. They've been giving banks a lot of extra money, but the banks aren't using it to lend more or spend more like they're supposed to. This could be a problem because it might make prices go up too fast, and that's something they don't want. The text also talks about how the Bank of Canada is changing some of its plans because things are different now. Why this is important? This is important because it's about making sure money is used the right way and prices don't go up too fast. When prices rise too quickly, it can make things more expensive, and that's not good for people. So the people in charge of money need to be careful with what they do. It's like making sure the money machine runs smoothly. Anchored inflation expectations and the challenges of increasing inflation targets. The text discusses the importance of anchored inflation expectations for a successful monetary policy and explains why central banks have not increased their inflation targets. It also highlights the potential risks of raising inflation targets, such as greater sensitivity to inflation and increased volatility over the longer run. The text goes on to acknowledge that large-scale asset purchases can ease financial conditions, and notes that central banks need to be mindful of the potential effects on inflation expectations of expanding their balance sheets. So simply, this text talks about why it's important to make sure that prices don't go up too fast. When people expect prices to stay about the same, it helps the people in charge of money, they're called central banks, do their job better. They want to keep prices from rising too much, so they set a target for how much prices should go up each year. But they're careful not to set the target too high because that could lead to more problems with prices and make things less stable. It could also make prices go up and down a lot. The text also mentions that central banks can use some tricks to make it easier for people to borrow money and make things better for the economy. But they have to be careful not to use too many tricks, or it might make people think prices will go up too much. Why this is important? This is important because when prices go up too fast, it can make life harder for everyone. Central banks have a tough job to make sure prices stay in control. It's like they're trying to keep a lid on a pot to stop it from boiling over. The potential of the Federal Reserve's balance sheet and the risk of inflation. The Federal Reserve's balance sheet is a potential source of policy stimulus, but higher inflation expectations could result. Inflation concerns would be a matter of concern to the FOMC. Tools to reverse unusual actions are essential to allay fears of inflation. New tools are being developed to drain reserves when necessary. Monetary policy should focus on price stability and high employment, while prudential regulation can address financial imbalances. The most severe financial crisis since the Great Depression has caused suffering around the world. So simply, the Federal Reserve has a big pile of money that it can use to help the economy when things get tough. But if they use too much of this money, it might make prices go up a lot, and that's not good. When people start worrying about prices going up too fast, it becomes a big deal for the people who make decisions about money. They're called the FOMC. To make sure prices don't go crazy, they need to have some special tools to undo what they did if it starts causing problems. They're also coming up with new ways to take money out of the system when they need to. Their main job is to keep prices stable and make sure lots of people have jobs. But they also want to stop big financial problems like the one we had during the Great Depression. Why this is important? This is important because it's all about making sure the economy stays healthy. Too much money can make prices go up fast, which is bad for people's wallets. So the Federal Reserve needs to be really careful with its money moves to keep everything in balance. It's like being a money doctor for the economy. Reassessing central bank strategies promoting financial stability in modern markets. The global financial crisis of the late 2000s was a challenging experience for central bankers. They must reassess their strategies and tools to ensure economic and price stability in modern financial markets. While the answers are unclear, constructive discussions can improve their ability to promote financial stability and reduce the likelihood of future crises. So simply, central bankers had a tough time during the big money crisis in the late 2000s. Now they're thinking about how to do their job better and keep the economy safe in today's world of money. They need to find new strategies and tools to make sure the economy stays stable and prices don't go crazy. Even though they don't have all the answers yet, they're talking and trying to come up with good ideas. These discussions can help them do a better job of keeping the economy safe and making sure big financial problems don't happen again. Why this is important? This is important because it's about keeping our money system strong and safe. Central banks are like the guardians of the economy, and when they figure out how to do their job better, it means less chance of big money troubles in the future. So it's like they're working to keep our financial world secure. Exploring the diverse landscape of financial institutions, the text provides an overview of various types of financial institutions, including banks, credit unions, savings and loan associations, investment banks, brokerage firms, insurance companies, and mortgage companies. These institutions offer different services, such as online banking, mortgage loans, and investment advice. Some are owned by their customers or community, while others are publicly traded. The text also highlights the unique features of each type of financial institution. So simply, this text talks about all the different kinds of places where people deal with money. You've got banks, credit unions, places that give out mortgage loans, fancy banks called investment banks, places that help you buy and sell investments, they're called brokerage firms, companies that help protect you from bad stuff happening, they're insurance companies, and the folks who lend you money to buy a house, they're mortgage companies. Each of these money places does different things. Some are like neighborhood shops run by the people who use them, while others are like big companies that anyone can buy a piece of. This text also explains what makes each money place special. Why this is important because it helps us understand where we can go for different money needs. Whether you want to save money, borrow for a house, or invest for the future, there's a place for you. Knowing about all these money places is like having a map to find the right one for your financial journey. Role of financial institutions in economic stability and prosperity. Financial institutions provide a variety of services, including mortgage loans, investment vehicles, and fair financial practices. They are essential for regulating the economy and ensuring prosperity. So simply, financial institutions are like banks and other money experts. They do a lot of things like giving people loans to buy houses, helping with investments, and making sure everyone plays fair with their money. These money experts help keep the economy running smoothly and make sure things are going well for everyone. Why this is important because it keeps the economy on the right track. When financial institutions do their job well, people can buy homes, save money, and invest for the future. It's like having financial experts in charge to make sure everything is fair and everyone gets a fair shot at financial success. The role of financial markets in capital allocation. Financial markets provide a platform for capital allocation and matching those who have capital with those who need it. They include capital markets, derivative markets, money markets, and currency markets. So simply, financial markets are like places where people can go to get the money they need. These places have different sections, like capital markets, derivative markets, money markets, and currency markets. Each section helps people in different ways to get the money they need. Why this is important? This is important because it makes it easy for people to find money when they need it. When people and businesses can get the money they need, they can do things like start a new business, build a house, or invest in the stock market. Financial markets are like a one-stop shop for money, and that keeps the economy going strong. The vital role of financial markets in capital allocation. Financial markets play a crucial role in allocating capital by matching those who have it with those who need it for growth and expansion. They facilitate the raising of capital through capital markets and the transfer of liquidity through money markets, while also providing a platform for the resale of financial instruments. Without these markets, borrowers would struggle to find lenders. So simply, financial markets are like the magical place where money goes to find the right job. They connect the people who have money to the people who need money to make their businesses grow. It's like a matchmaking service for money. These markets have two main parts. One part helps businesses get the money they need to grow, like when they want to build a new factory or expand their operations. The other part helps with quick money moves, like when businesses need cash fast. Without these markets, it would be really hard for businesses to find the money they need to keep growing and doing well. Why this is important? This is important because it keeps the financial world running smoothly. When businesses can easily find the money they need, they can keep growing, and that's good for the economy. Financial markets make it all work like a well-oiled machine. The role of financial markets in feedback and valuation for management decisions. Financial markets provide feedback to management through the price discovery process, which determines the allocation of funds based on demand and supply. They also allow complex transactions, such as stock exchanges, to take place. Management uses market research to gain feedback on their business, but financial markets can also provide valuable insight into a company's financial value compared to its competitors. However, the stock market's volatility can make this feedback less useful at times. So simply, financial markets are like the place where companies and investors meet to buy and sell stuff. They give feedback to company bosses by showing how much people want to buy their stuff and how much they're willing to pay. This helps companies decide where to put their money. Financial markets also make it possible for companies to do complicated things, like trading stocks. Companies check what's happening in these markets to see how people feel about their business. It's like a report card for companies. But sometimes when the stock market goes up and down a lot, the report card isn't so clear. Why this is important? This is important because it helps companies figure out where they should invest their money. Financial markets tell them what's hot and what's not. But when the stock market is all over the place, it can make it harder for companies to make good decisions. Enhancing investor protection. The Securities Act of 1933. The Securities Act of 1933 ensures investors receive complete and accurate information before they invest. The Act's objectives are to provide investors with material financial and other corporate information about issuers of public securities. The primary purpose of the 33 Act is to ensure that buyers of securities receive complete and accurate information before they invest. So simply, the Securities Act of 1933 is like a safety measure to make sure people who want to invest their money get all the important information they need. Its main job is to make sure that when people want to buy investments, like stocks, they get all the right and true information about the companies that are selling those investments. Why this is important? This is important because it's all about protecting the people who want to invest their money. When they have all the facts, they can make better decisions, and they're less likely to get tricked or cheated. The 1933 Securities Act is like a guardian that makes sure everyone plays by the rules and keeps things fair for investors. Navigating securities regulation, an overview of the Securities Act of 1933 and Rule 144. The Securities Act of 1933 requires registration of securities offers and sales. Many transactions are exempt from regulation. The prospectus is included in the registration statement. Rule 144 allows the sale of restricted securities without registration, subject to certain requirements. So simply, in 1933, they made a rule book called the Securities Act. This rule book says that when people want to sell investments, they usually have to tell the government about it. But there are some exceptions, which means not all transactions have to follow these rules. When people want to sell these investments, they usually need to give potential buyers a document that explains all the important details about the investment. This document is called prospectus, and it's part of the paperwork they give to the government. Now, there's also something called Rule 144. This rule says that some investments can be sold without telling the government first, but there are certain things you have to do to make it okay. Why this is important because it's all about making sure that when people buy investments, they have the information they need to make good decisions. It also explains how some investments can be sold without telling the government, as long as everyone follows the special rules in Rule 144. This helps keep things fair and safe in the world of investing. Regulating secondary trading, the Securities Exchange Act of 1934. The Securities Exchange Act of 1934 regulates the secondary trading of securities and their participants in the United States. So simply, back in 1934, they made a law called the Securities Exchange Act. This law is all about making sure that when people buy and sell investments, like stocks, for the second time they call it secondary trading, everything is done properly. It sets the rules for how these transactions happen in the United States. Why this is important because it helps make sure that the buying and selling of investments are fair and safe, not just the first time, but also when people trade them again. It's like having a referee to make sure everyone plays by the rules in the financial game. This way, people can trust the system and feel confident about their investments. Securities Exchange Act of 1934 regulating financial markets and protecting investors. The Securities Exchange Act of 1934 regulates the trading of securities in the United States. It established that SEC and covers brokers, dealers, and private traders. The act also regulates stock exchanges and provides for self-regulatory organizations. So simply, in 1934, a law called the Securities Exchange Act was made to make sure everything was fair in the world of buying and selling investments like stocks. This law set up something called the SEC to watch over the people who buy and sell these investments, like brokers and dealers. It also made rules for the places where these investments are traded, like stock exchanges. Plus, it said that the people who run these places have to follow rules to make sure everything is honest. Why this is important? This is important because it's all about keeping the money world honest and safe for everyone. When there are rules in place, it means that people can trust that their investments are being handled the right way, which is good for everyone involved. The evolving landscape of ATS consolidation, regulation, and investor confidence. ATS is a small market with low volumes and controlled by a few brokers/dealers. ATS requires registration as a broker/exchange or operate unregulated with low trading caps. Issuers must regularly file company info with SEC on certain forms. Anti-fraud provision of 33 Act extended to secondary market by 34 Act. Sarbanes-Oxley Act set new standards for public boards, management, and accounting firms. Opponents claim it reduced competitive edge versus foreign providers. Proponents say it improved investor confidence. So simply, ATS, which is like a smaller stock market, has seen some changes. It doesn't have a lot of trading, and just a few brokers and dealers control it. To make things fair, there are rules called Reg ATS. These rules say that you need to register as a broker or exchange, or you can operate without much trading. If you want to be part of this market, you have to regularly share information about your company with the SEC on specific forms. There are also rules that stop people from lying and cheating in this market. They were made to protect investors. Another law called the Sarbanes-Oxley Act set new standards for how companies run things to make sure they're honest. Some people don't like these rules because they think they make it harder for U.S. companies to compete with foreign ones. But others say they've made investors feel more confident. Why this is important? This is important because it's all about making the stock market fair and safe. It's like setting up rules for a game to make sure no one cheats and everyone plays by the same rules. This way, investors can feel more confident that their money is in good hands. The impact of the Sarbanes-Oxley Act on financial governance and accountability. The Sarbanes-Oxley Act of 2002 is a federal law that set new or enhanced standards for all public company boards, management, and public accounting firms in the United States. It increases financial governance, auditor independence, and senior executive responsibility for accurate financial reports. So simply, the Sarbanes-Oxley Act of 2002, also known as SOX, is like a big set of rules that all public companies in the United States have to follow. It makes sure that the people who run these companies, the folks who check their finances, and the top bosses are all doing a great job. SOX makes sure that everyone is responsible for telling the truth about the company's money. It also helps make sure that the people checking the company's finances are independent and not influenced by the company's leaders. Why this is important? This is important because it's all about trust and honesty in the business world. When companies follow these rules, it means that the financial information they share is more likely to be accurate and reliable. This helps investors and everyone else who depends on that information to make smart decisions. Enhancing corporate accountability, the Sarbanes-Oxley Act, and the pursuit of investor protection, the Sarbanes-Oxley Act of 2002 SOX aims to protect investors by improving the accuracy and reliability of corporate disclosures. It introduced new financial reporting requirements, auditing standards, and penalties for non-compliance. The Act also established the Public Company Accounting Oversight Board (PCAOB) to oversee the auditing profession. So simply, the Sarbanes-Oxley Act of 2002, often called SOX, is like a set of rules to make sure companies tell the truth and don't trick investors. It's all about making sure that when companies share their financial information, it's accurate and reliable. SOX brought in new rules for how companies report their finances, set standards for how they get checked by auditors, and added punishments if they don't follow the rules. The Act also created something called the Public Company Accounting Oversight Board (PCAOB) to watch over the people who check a company's financial information. Why this is important? This is important because it helps protect people who invest their money in companies. When companies are honest about their finances, it helps investors make smart decisions. SOX is like a referee making sure companies play by the rules, which keeps the investment game fair and safe for everyone. Insider trading charges against former CEO and friend. The SEC charged a former CEO and his friend with insider trading for profiting from non-public merger discussions. So simply, the SEC, which makes sure people follow the rules in the stock market, said that a former CEO and his friend did something wrong. They made money by using secret information about a company merger that hadn't been made public yet. Why this is important? This is important because it shows that even big shots like former CEOs have to follow the rules. Insider trading is when people use secret information to make money in the stock market, and it's not allowed. The SEC steps in to make sure these rules are followed and to hold people accountable when they don't. Insider trading scandal. Redmond and Signarasty settled with SEC. Redmond shared confidential corporate information with Signarasty about Genentech's sale. They violated fiduciary duties and traded on insider information. SEC charged them for profiting from insider trading. Redmond and Signarasty settled for over $324,000, and Redmond was barred from serving as a public company officer for 5 years. So simply, Redmond and Signarasty did something wrong. Redmond told Signarasty secret stuff about the company Genentech when it was being sold. This was against the rules, and they used this secret info to make money from the stock market. But SEC, which makes sure people follow the stock market rules, said they did a bad thing and charged them. To make things right, Redmond and Signarasty agreed to pay over $324,000. Redmond also can't be in charge of a big company for 5 years. Why this is important? This is important because it shows what can happen when people break the rules in the stock market. In this case, they shared secret information and made money from it. The SEC steps in to make sure these rules are followed, and when someone doesn't, they have to pay a price. It's a reminder that honesty and following the rules are important in the business world. Comparing different forms of business organization, the different forms of business organization include sole proprietorship, partnership, and corporation. The sole proprietorship has the advantage of simplicity and control, but the drawback of unlimited liability. In a partnership, the structure has the benefit of simplicity and control, but the drawback of personal liability for the partnership's activities. So simply, When you want to start a business, there are a few ways to do it. You can go solo, which is called a sole proprietorship. It's simple, and you're in charge, but if things go wrong, you're on the hook for all the problems. You can also partner up with someone like a friend or family member. This is called a partnership. It's also simple, and you both run the show. But if things get messy, you're both responsible for the issues. Why this is important? This is important because when you're starting a business, you need to think about how you want to organize it. Each way has its pros and cons, like simplicity and control, but also things like personal responsibility if things go south. Understanding these options helps you make the right choice for your business. Exploring the advantages and types of partnerships for multi-entrepreneur businesses. The partnership is a business structure open to businesses run and owned by two or more entrepreneurs. It is easy to form and tax treatment is simple. However, partners can be personally liable for business losses. Limited partnerships and limited liability partnerships are types of partnerships that mitigate some of the disadvantages. So simply, a partnership is like a way to run a business together with other people. It's easy to set up, and the way you pay taxes is straightforward. But there's a little catch: if the business loses money, the people in the partnership might have to pay for it from their own pockets. Now there are some special types of partnerships, like limited partnerships and limited liability partnerships. These kinds help reduce the risk of losing lots of money if the business doesn't do well. Why this is important? This is important because it explains why partnerships can be a smart choice for businesses with more than one person running things. They're easy to start, and the tax stuff is simple. But it's also important to know about the risks and how special types of partnerships can make things safer for everyone involved. Unlocking the benefits, exploring the flexibility and protection of limited liability companies. Limited liability companies, LLCs, are business structures that protect their owners from being personally responsible for the company's debts or liabilities. They combine features of partnerships and corporations, offering flexibility and protection for investors. Any entity or individual can be a member of an LLC, with the exception of banks and insurance companies. LLCs do not pay taxes directly. Instead, their profits and losses are passed through to members who report them on their individual tax returns. So simply, limited liability companies, LLCs, are like special business shields. They keep the people who own the company safe from having to pay for the company's money troubles. LLCs are cool because they borrow good things from teams and big companies, making them flexible and protective for the people who invest in them. Almost anyone, even regular folks and groups, can be part of an LLC. There are just a few exceptions, like banks and insurance companies. What's interesting is that LLCs don't pay taxes on their own. Instead, the money they make and the losses they have are passed on to the people who are part of the LLC. These people report it on their own tax forms. Why this is important? This is important because it helps us understand why LLCs are a popular choice for businesses. They offer a mix of flexibility and protection, making them great for all sorts of people who want to start a business without taking on too much personal risk. Plus, they come with some clever tax benefits that can save people money. The benefits of limited liability companies for small business owners. Limited liability companies, LLCs, are a hybrid business structure that combines features of a corporation and a partnership. They provide limited liability to their owners while allowing profits to be passed through to their personal income tax returns. LLCs are commonly used by small business owners for their flexibility and tax benefits. So simply, limited liability companies, LLCs, are like a mix of a big company and a small team. They give the people who own the business some protection so that they're not on the hook for everything if things go wrong. Plus, the money the business makes can go right to the owners and get taxed like their own personal money. Small business owners really like using LLCs because they're flexible, and they come with some tax perks that can save them money. Why this is important? This is important because it explains why small business owners often choose LLCs. They offer a balance of protection and tax benefits, making them a smart choice for small businesses to grow and succeed while also protecting their owners from potential financial problems. The advantages of limited liability companies, LLCs. Limited liability companies, LLCs, are a popular business structure due to their simplified taxation and protection of personal assets from business liabilities. Examples of LLCs include Alphabet, PepsiCo, ExxonMobil, and Johnson & Johnson. LLCs allow profits to be passed directly to owners to be taxed as personal income, avoiding double taxation. Many physicians groups and smaller businesses also used LLCs for liability protection. So simply, limited liability companies LLCs are a common way for businesses to set themselves up because they make taxes simple and protect the owner's personal stuff from any money problems the business might have. Some well-known companies like Alphabet, PepsiCo, ExxonMobil, and Johnson & Johnson are structured as LLCs. One big advantage of LLCs is that the money the business makes can go directly to the owners and gets taxed like their personal income. This way, they don't have to pay taxes on it twice. Many small businesses and groups of doctors also use LLCs to protect themselves from financial troubles. Why this is important? This is important because it explains why LLCs are a popular choice for businesses. They offer benefits like easy tax rules and protecting the owner's personal stuff from business problems. This can make it easier for businesses to thrive and grow while also providing financial protection for the people who own them. The dual nature of corporations balancing conflicts and advantages for shareholders. The corporation is a vehicle for the separation of ownership and control, which can lead to agency conflicts between managers and shareholders. These conflicts can arise due to differences in incentives and goals, and can result in decreased firm value. However, the corporate structure also offers benefits such as limited liability, easily transferable ownership, and tax advantages. As corporations are a hybrid option that combines the legal environment of standard corporations with pass-through taxation similar to partnerships, potentially offering the best of both worlds. So simply, companies, also known as corporations, have a unique structure where the people who own them, shareholders, are often not the same as the people who manage them, managers. This separation can sometimes cause disagreements or conflicts because managers might have different interests and goals than shareholders. These conflicts can lead to the company's value decreasing. However, companies also come with advantages like limited liability, which means shareholders' personal assets are protected if the company faces financial trouble. Shares of a company can be easily bought or sold, and there can be tax benefits. Some companies, called S-corporations, try to combine the best parts of regular companies and partnerships, offering benefits for both the owners and managers. Why this is important? It's important because it helps us understand how companies work. There can be conflicts between the owners and managers, but there are also benefits like protection for shareholders and tax advantages. Recognizing this balance helps us make informed decisions about how companies are structured and how they can benefit both the owners and managers. Managing conflict, the principal agent problem and its impact on shareholder value. The principal agent problem in corporate governance arises from the separation of ownership and control, leading to conflicts of interest between managers and shareholders. Agency costs result from this conflict and include the cost of monitoring and incentivizing managers to act in shareholders' interests. Moral hazard and conflict of interest may also arise, leading to suboptimal decision-making and reduced shareholder value. So simply, in companies, there can be a tricky issue called the principal agent problem. This happens when the people who own the company's shares, the shareholders, are not the same as the people who manage the company, the managers. Because they have different roles, they might not always agree on what's best for the company. When they don't agree, it can cause some extra costs, like the cost of keeping an eye on what the managers are doing and encouraging them to make choices that benefit the shareholders. There can also be issues like managers taking too many risks or making decisions that favor themselves over the shareholders. All of this can lead to not so great decision-making and less money for the shareholders. Why this is important? This is important because it helps us understand why conflicts and disagreements in a company matter. When managers and shareholders have different interests, it can lead to extra costs and less money for the shareholders. Solving these conflicts is important to make sure the company does well and the people who own it benefit. Navigating conflicts of interest, balancing stakeholder objectives for corporate success. Conflicts of interest can arise between stakeholders in a corporation, such as managers, shareholders, and bondholders, due to differing objectives and rewards. These conflicts can result in actions that are not in the best interest of the company or its stakeholders. So simply, sometimes people involved in a company, like the managers, the owners, shareholders, and the people who lent money, bondholders, might not always agree. This happens because they each have different goals and want different things. When they can't agree, It can lead to actions that aren't good for the company or the people involved with it. Why this is important? This is important because when there are disagreements and conflicts of interest in a company, it can cause problems and make it hard for the company to succeed. Finding a way to balance everyone's goals and interests is essential to make sure the company does well and that everyone involved benefits. Unveiling manager-shareholder conflicts. A call for strong corporate governance. Managers may have conflicts of interest with shareholders when making decisions, leading to agency costs. They may engage in self-dealing, buy other companies, or manipulate financial figures to optimize bonuses. Contemporary discussions of corporate governance argue for respecting shareholder rights and disclosure. So simply, sometimes the people who manage a company might not always make decisions that are in the best interest of the people who own shares in that company. This can lead to extra costs. Managers might do things like making deals that benefit themselves, buying other companies, or changing the financial numbers to get bigger bonuses for themselves. Today, when we talk about how a company should be run, many people say that we need to follow good rules to make sure the owner shareholders are treated fairly and that all the important information is shared with them. Why this is important? This is important because when the managers and the owners of a company don't always agree, it can cause problems and extra costs. We need to have good rules and ways of running companies to make sure that the owner's rights are respected and that everything is open and clear. This helps the company run smoothly and makes sure everyone is treated fairly. Unveiling the clash of interest. Shareholders versus bondholders in corporate dynamics. The text summarizes the differences and potential conflicts between shareholders and bondholders in a corporation. Shareholders have voting rights and an incentive to take risky projects, while bondholders are more interested in safe strategies with high chances of getting their investment back. Bondholders often create contracts prohibiting risky projects or raise interest rates. So simply, this text talks about how people who own shares, shareholders, and people who lend money, bondholders, to a company might have different ideas and sometimes disagreements. Shareholders can vote on important decisions, and they might want to try things that are a bit risky because it could make the company more money. On the other hand, bondholders are more interested in playing it safe and making sure they get their money back. Sometimes bondholders make agreements that stop the company from taking too many risks, or they ask for higher interest rates when they lend money to make up for the extra risk. Why this is important? This is important because understanding the differences and conflicts between shareholders and bondholders helps us see how companies make decisions and manage their money. It's like a clash of opinions, and finding the right balance is essential to keep a company running smoothly and everyone happy. Strategic financial management. Balancing shareholder value and bondholder demands. The text discusses the importance of strategic financial management in a company, which involves managing finances with the goal of achieving long-term objectives and maximizing shareholder value. It also highlights the potential conflicts that can arise between shareholder preferences and bondholder demands, which can impact the company's financial decisions. So simply, this text talks about how important it is for a company to handle its money wisely. This means making sure they have a plan that helps them reach their long-term goals and makes the people who own shares in the company happy by increasing the value of their shares. Sometimes there can be disagreements between the shareholders, the people who own shares, and the bondholders, people who lent money to the company by buying bonds. These disagreements can affect how the company makes financial choices. Why this is important? This is important because managing a company's money well is like having a plan for success. It helps the company grow and makes everyone who invested in the company, whether through shares or bonds, happy. But sometimes there can be conflicts between these groups, and finding the right balance is crucial to keep the company on the right track. Balancing stakeholder needs and long-term financial health. The key to strategic management. The text explains that companies may need to make short-term sacrifices to improve their long-term financial health, and that these decisions often involve balancing the needs of various stakeholders. The elements of strategic financial management are also discussed, including planning, budgeting, risk management, and industry-specific strategies. The benefits of strategic management are also highlighted, including maintaining focus on long-term goals despite short-term challenges. So simply, The text talks about how sometimes companies have to do things that might not seem great right now to make sure they have lots of money and are healthy in the future. It's like saving money for a rainy day. This can mean finding a balance between what different people want from the company. The text also mentions some important parts of planning for the company's money, like making budgets, being careful about risks, and using strategies that fit the kind of business they're in. These things help the company stay focused on their long-term goals, even when they face tough times in the short term. Why this is important? This is important because it's like making sure the company is strong and can keep everyone happy in the long run. Sometimes they have to make choices that might not be great for the moment, but help them be healthy and rich in the future. Good planning and finding the right balance are key to making sure the company succeeds in the long term, even when they face challenges along the way. Maximizing profitability and stability, the role of strategic financial management. Strategic management helps firms stay profitable and stable by setting long-term goals and guidelines for achieving them despite challenges. Financial management plays a key role in this, involving cost reduction, risk management, and budgeting. The ultimate objective of strategic financial management is to ensure that long-term goals are properly planned for and met. Valuation is a goal of financial management that often relies on fundamental analysis of financial statements. An accurate valuation depends on reliable financial information. Financial management focuses on the practical significance of financial numbers and creates value through the allocation of scarce resources among competing business opportunities. So simply, strategic management is like making a game plan for a company to make sure it keeps making money and stays strong, even when things get tough. Financial management is a big part of this and involves things like finding ways to spend less, handling risks, and setting budgets. The main goal of strategic financial management is to make sure the company's long-term plans are well thought out and work out as intended. One thing they focus on is figuring out how much the company is worth, which is called valuation. To do this, they look at the company's financial records and make sure they are accurate. Financial management is all about making sure the money is used wisely and helps the company grow, even when there are different business options to choose from. Why this is important? This is important because having a good plan is like having a roadmap to success for a company. It ensures that a company can continue to make money and stay strong even when they face challenges. Financial management is a crucial part of this plan because it helps a company use its money wisely, reduces risks, and makes sure they reach their long-term goals. It's all about keeping the company in good shape and growing over time. The pursuit of shareholder wealth. A financial management perspective, the goal of financial management is to maximize shareholder wealth by paying dividends and increasing the market value of the company. Financial management involves analyzing financial numbers to make informed decisions. One interpretation of financial management is that agents should focus on increasing shareholder value, which can be achieved through dividends or increasing the stock price/market value. So simply, financial management is about making money decisions that make the people who own shares in a company feel richer. This is done by giving them a part of the profits as dividends and by making the company worth more when its shares are traded. Financial managers use numbers to figure out what's best to do. One way to see financial management is as a job where the people in charge should try to make shareholders wealthier. They can do this by sharing profits with them through dividends or by making the company's stock price go up. Why this is important? This is important because it explains what financial management is all about. It's about making sure that the people who own shares in a company, the shareholders, are happy and see their investments grow. This helps them trust the company and continue to invest. So, financial managers need to make choices that keep shareholders wealthy and satisfied. Balancing stakeholder interests in financial management. The goal of financial management is to maximize value for stakeholders while avoiding harm to any of them. This involves considering the interests of different stakeholders, including shareholders, employees, customers, suppliers, and the environment. The debate surrounding the proper goal of financial management centers around whether it should prioritize shareholder value or stakeholder interests. While the Anglo-American model tends to emphasize shareholders, some European countries recognize other stakeholders in corporate governance decisions. Some argue that considering stakeholders can enhance outcomes for all parties involved. while others prioritize maximizing shareholder value without harming stakeholders. So simply, to figure out how much a company is worth, you multiply how many shares they have by the price of each share. People who manage a company's money care about what all the financial numbers mean in real life. They want to make sure the company becomes more valuable, but they don't want to hurt the people who own shares. The idea of stakeholders is about who's involved with the company and what they care about. This includes the folks who own shares, the employees, the customers, and even the environment. Some people argue about whether companies should focus mainly on making shareholders happy or if they should also think about all these other groups. Some say that considering everyone's interests can make things better for the company overall, and businesses shouldn't hurt anyone, even if they don't always make decisions with them in mind. Why this is important? This is important because it's about finding the right balance between making the company more valuable and taking care of everyone connected to it. There's a debate about whether companies should only focus on making shareholders happy or if they should also think about the other people and the environment. Striking the right balance can lead to better outcomes for everyone and help companies avoid causing harm while making important decisions. Maximizing stakeholder value, balancing shareholders and other interests. The total value of a company is calculated by multiplying the number of shares outstanding by the price per share. Financial management professionals are concerned with the practical significance of financial data. They aim to maximize value without harming shareholders. The stakeholder concept is associated with corporate governance and involves considering the interests of various groups, including shareholders, employees, customers, and the environment. There is debate about whether companies should prioritize shareholder value or consider other stakeholders. Some argue that considering other stakeholders can enhance overall outcomes and that businesses should not harm stakeholders even if they are not considered in decision-making. So simply, innovative policies adapting the Federal Reserve's methods amidst the financial crisis. The Federal Reserve had to adapt and innovate its policies during the financial crisis to provide liquidity to non-bank financial institutions and ease financial conditions. These innovations included providing guidance on future interest rates, purchasing longer-term securities, and creating unprecedented volumes of bank reserves. So simply, during the financial crisis, the Federal Reserve had to come up with new ideas to help non-bank financial institutions and make things easier in the financial world. They did things like giving hints about what interest rates would be like in the future, buying investments that take a long time to pay off, and making lots of extra money available to banks. Why this is important? This is important because the financial crisis was a tough time, and the Federal Reserve had to think creatively to keep the financial system working. Their new approaches, like guiding interest rates and creating extra money, played a big role in stabilizing the situation. Understanding how they adapted their methods can help us be better prepared for future financial challenges. Adapting liquidity facilities addressing financial market strains in the 2008 crisis. The financial crisis of 2008 led to a shortage of liquidity in financial markets, causing disruptions to financing markets and exacerbating the recession. Central banks, including the Federal Reserve, had to adapt their liquidity facilities to address these strains. So simply, in 2008, there wasn't enough available money in the financial markets. This caused issues with borrowing and lending money and made the economic downturn even worse. Central banks, like the Federal Reserve, had to change how they provided emergency money to deal with these problems. Why this is important? This is important because when there's not enough money available in financial markets during a crisis, it can lead to problems in borrowing and lending money, which can make the economic situation even worse. Central banks had to adapt to make sure there was enough money to keep things stable and prevent the crisis from getting worse. Understanding how they did this can help us be better prepared for future financial crises. Unconventional lending and innovations. The Federal Reserve's response to the 2007-2008 financial crisis. The Federal Reserve had to take emergency actions during the financial crisis of 2007-2008 because the routine lending practices to commercial banks were not enough to address the severe strains in short-term financing markets. The crisis was caused by deficiencies in securitization and derivative instruments that exposed banks to risks they did not fully understand. The Federal Reserve's lending actions during the crisis were innovative and legal and adhered to Bagehot's principles of lending early and freely to solvent institutions at a penalty rate and against good collateral. So simply, when the big financial crisis happened in 2007 to 2008, the usual way of lending money to commercial banks wasn't enough to fix the problem. This crisis happened because there were problems with how banks were handling financial instruments like securities and derivatives, which are like complex financial contracts. These problems put banks at risk, and they didn't fully understand the dangers. To deal with this, the Federal Reserve had to do some things that were new and different. They lent money to banks in a way that followed the rules, and they did it quickly to help banks that were still in good shape, but needed some extra cash. They also made sure they got valuable things as collateral to secure the loans. It's important because when a big financial crisis hits, the usual methods of helping banks might not be enough. The Federal Reserve had to come up with new ways to lend money to make sure the economy didn't collapse. They followed important rules to do this, and it helped prevent a bad situation from getting worse. Understanding how they acted in a crisis is vital for ensuring that we can handle future financial emergencies better. The role of the Federal Reserve in averting financial instability. The financial crisis led to funding pressures for financial institutions and others. The Federal Reserve assumed liquidity risk by lending to solvent institutions against illiquid collateral. Central banks' ability to substitute for private sector intermediation in a panic is unlimited. Lending against good collateral supplies liquidity, not capital. The Federal Reserve worked with the Treasury to restart securitization markets through the TALF. The effectiveness of emergency liquidity facilities suggests improved financial conditions. So simply, during the financial crisis, many financial institutions and other groups were running out of money. The Federal Reserve stepped in to help by lending money to institutions that were financially okay, but had assets that were tough to turn into cash. When there's a big money crisis, central banks like the Federal Reserve can step in and provide money when private companies can't. The money they lent was to help with short-term money problems, not to give those institutions more capital. The Federal Reserve also worked with the Treasury to get the securitization market, a way to bundle and sell loans, back on its feet, which helped make things better in the financial world. It's important because when there's a big financial problem, the Federal Reserve can step in and provide money to keep things from falling apart. They don't give out money to make institutions richer, but to help them deal with short-term money troubles. This helps make the financial system more stable and prevents a big financial crisis from happening. Lessons learned from the Federal Reserve's crisis interventions, balancing stability and moral hazard. The Federal Reserve's actions during the financial crisis, including the establishment of emergency liquidity facilities, helped to stem market panic and stabilize the economy. However, the reliance on these facilities should be limited to avoid moral hazard and protect market functioning. The Fed's experiences have highlighted the need for authority to lend to other regulated financial institutions beyond banks, and for close supervision of potential borrowers to prevent excessive risk-taking. So simply, when there was a big financial crisis, the Federal Reserve did things to stop the panic and make the economy stable again. They set up places where money could be borrowed quickly to calm down the markets. But we need to be careful and not use these places too much, or people might start taking big risks, thinking they'll always get help. The Federal Reserve's experience showed that they should be able to lend money to other regulated financial groups, not just banks. They should also keep a close eye on who's borrowing money to make sure they're not taking too many risks. Why this is important? This is important because the Federal Reserve's actions during the crisis helped prevent a big disaster. But if we use these emergency places too much, it might encourage people to be careless with their money, thinking they'll always get bailed out. We also learned that the Federal Reserve should be able to lend to different kinds of financial groups and keep a close watch on them to avoid problems. It's all about keeping things fair and making sure our financial system is stable. Addressing regulatory gaps and ensuring financial stability in the United States, the financial crisis highlighted the need for better regulation of banks and lenders to prevent risky behavior that could lead to another crisis. The United States needs a resolution facility for systemically important institutions that meets certain criteria, including access to liquidity and fiscal authorities deciding whether to take on credit risk. Central banks should be transparent about their actions, especially during unusual liquidity facilities. The problem of discount window stigma is real and serious, and central banks need to be able to stabilize the financial system in a panic. In response to the deepening crisis in 2008, the Federal Reserve took aggressive action to reduce policy interest rates and ease financial conditions, including communicating expectations for exceptionally low rates for an extended period. So simply, when the big financial crisis happened, it showed that we needed better rules to control what banks and lenders can do. We didn't want them taking big risks that could cause another crisis. The United States should have a plan to deal with really important banks if they run into trouble. This plan should meet certain requirements, like having a way to get money quickly and having government authorities decide if they should help out. Central banks, which manage the country's money, need to be clear about what they're doing, especially when they're doing things that aren't normal. There's a big problem where banks are embarrassed to ask for help when they need it, and central banks should be able to help out when there's a financial crisis. Why this is important? This is important because the financial crisis in 2008 showed that we need to have better rules to keep our money safe. We don't want banks and lenders taking huge risks that could hurt the economy. We also need a plan to deal with big banks if they get in trouble. Being clear about what central banks are doing is important, and we should make it easier for banks to ask for help when things go wrong. All of this helps keep our financial system stable and secure. Federal Reserve's strategic measures tackle financial crisis and safeguard economy. The Federal Reserve took several actions to combat the financial crisis, including lowering interest rates to zero and buying long-term securities to reduce borrowing costs. These steps helped keep inflation expectations in check and prevented further economic contraction. So simply, during the financial crisis, the Federal Reserve did a few things to try to fix the problem. They made interest rates super low and bought things like long-term investments to make it cheaper for people to borrow money. This helped make sure that people didn't start thinking that prices would go up a lot, that's called inflation, and stop the economy from getting even worse. Why this is important? This is important because the actions the Federal Reserve took helped keep the economy from falling apart during the financial crisis. They made it easier for people and businesses to get the money they needed, and this stopped prices from rising too fast. If they hadn't done these things, the financial crisis could have been even more damaging for everyone. The impact of extended period language and large-scale asset purchases on interest rates. Market participants interpreted the extended period language in the Fed's statement as stronger than the previous for some time language. However, the language did not prevent interest rate expectations from reacting to incoming economic information. The effects of large-scale asset purchases are less well understood, but studies suggest they have had a significant impact on interest rates. The Federal Reserve has funded its purchases by crediting banks' accounts, leading to a large volume of reserves in the banking system. So simply, people in the market saw the words extended period in the Federal Reserve's message as more powerful than the old for some time words. But even with these new words, what folks expected about interest rates still changed when they got new info about the economy. When it comes to those big purchases the Federal Reserve made, we're not entirely sure how they work, but studies show they had a big effect on interest rates. To pay for these purchases, the Federal Reserve put money in banks' accounts, and this created lots of extra money in the banking system. Why this is important? It's important because the words the Federal Reserve uses and the things they buy can mess with how much interest you earn, or pay on things like loans. Even if they say certain words, it doesn't always mean things will stay the same. The Federal Reserve's big purchases and how they put money into banks also have a big impact on how interest rates behave. This affects things like how much you pay for a mortgage or how much you earn from your savings. So it's important to understand how all of this works. The uncertain impact of Federal Reserve's actions balancing reserves and inflation expectations. The Federal Reserve's actions during the financial crisis have been based on the Keynesian model of the liquidity trap, in which demand for reserves becomes perfectly elastic when short-term interest rates approach zero. The effect of large-scale purchases of longer-term assets on inflation expectations is still uncertain. The Federal Reserve's balance sheet can return to normal only if it reduces reserves and raises interest rates in a timely fashion. The Bank of Canada has recently revised its time commitment based on changing circumstances. So simply, the Federal Reserve, which manages the country's money, made some choices during the financial crisis. They followed a plan that's kind of like a theory by a guy named Keynes, where they thought that when interest rates get really low, it's easy to get money. They also did some big buying of things like investments that take a long time to pay off, but we're not sure how this affects what people think prices will do. For things to get back to normal at the Federal Reserve, they need to do two things: get rid of some of the extra money they have and make interest rates go up at the right time. The Bank of Canada, which is like the money manager for Canada, recently changed how long they'll stick to their plan because things are always changing. Why this is important? It's important because the decisions made by the Federal Reserve can impact the economy and how much things cost. If they don't handle their money and interest rates right, it can lead to problems. Other countries like Canada are also adjusting their plans to deal with changing situations, and this can have an effect on how money works and how prices behave. The dangers of increasing inflation targets unfair expectations and economic consequences. The author argues that increasing inflation targets could lead to more variable inflation and worse economic outcomes over time. They believe that inflation expectations would become unanchored as inflation moves up, and raising the longer-term objective for inflation could make expectations more sensitive to recent realized inflation. The author also suggests that large-scale asset purchases at the zero bound do help to ease financial conditions, and central banks need to be mindful of the potential effects on inflation expectations of the expansion of their balance sheet. So simply, the writer says that if we decide to aim for more inflation in the economy, it could make things worse in the long run. They think that people's predictions about how prices will change might get all mixed up as inflation goes higher. Also, if we set a higher goal for how much prices should go up, it could make people react more to how prices have changed recently. The writer also mentions that when the central bank buys a lot of stuff when interest rates are super low, it can help the economy, but they have to be careful because it might affect what people think will happen with prices. This is important because how we handle inflation, the rise in prices, can impact our financial lives. If we change the rules for how much prices should go up, it can make it hard for people to predict what things will cost in the future. It also matters how the central bank uses its money to help the economy, as it can influence what we expect prices to do. So, these decisions can affect our wallets and savings. Preparing the Federal Reserve for economic recovery, reversing extraordinary actions, and addressing financial imbalances, the Federal Reserve needs to be prepared to reverse its extraordinary actions when the economy recovers. The ability to pay interest on excess reserves and develop new tools to drain reserves are important for raising interest rates. While some argue that low interest rates lead to financial imbalances, the author suggests using prudential regulation to address these concerns. So simply, the Federal Reserve, which is like the country's money manager, has to be ready to undo some of the special things it did once the economy gets better. To raise interest rates, they need to be able to pay extra money on the reserves that banks have and create new ways to take away some of that extra money. Some people say that keeping interest rates low can cause problems with money, but the writer thinks we can use rules to keep things in check. This is important because the Federal Reserve plays a big role in how the country's money works. They need to be ready to make changes when the economy gets back on track and make sure that keeping interest rates low doesn't mess up our money system. Using rules to control things is one way to keep our money safe. The diverse landscape of financial institutions provide various services, including online banking, credit unions, savings and loans, investment banks, brokerage firms, insurance companies, and mortgage companies. So simply, there are lots of different places that take care of money, like banks you can use on the internet, credit unions, places where you save and borrow money, banks for investing, companies that help you buy and sell stocks, insurance companies, and companies that lend money for homes. It's important to know about these different money services because they affect our everyday financial lives. We use them to save, borrow, invest, and protect our money and property. Understanding the types of financial institutions helps us make smart choices with our money. Exploring the intricacies of financial institutions and markets, the text discusses different types of financial institutions and markets. It explains how banks make money and what makes some financial institutions safe. It also touches on the regulation of cryptocurrency exchanges and the role of financial intermediaries. So simply, in this text, we learn about different places that handle money and where it's used. We find out how banks earn money and what keeps some of these places safe. It also talks about the rules for trading digital money and how middlemen help with financial stuff. Why this is important: understanding financial institutions and markets is crucial because it helps us know where our money goes and how it's looked after. It also helps us keep our money safe and make sure that everyone plays by the rules when dealing with things like cryptocurrencies. Plus, knowing the role of financial intermediaries can help us manage our money better. The function and importance of financial markets: financial markets provide a platform for raising capital and allocating resources. They consist of various types of markets, including capital markets, money markets, and derivative markets, among others. The primary function of these markets is to match investors with companies or individuals seeking funding. Additionally, financial markets provide a means for investors to diversify their portfolios and manage risk. So simply, financial markets are like a hub where people get money and decide where it should go. There are different kinds of markets, like ones for getting money for a long time, just for a little while, and even for special things. The most important thing these markets do is connect people who want to invest their money with businesses or people who need that money. They also help people who invest to spread their money around in different places to stay safe. Why this is important: financial markets are super important because they help businesses get the money they need to grow and create new things. They also help people who save and invest their money to make it grow and keep it safe. Without these markets, it would be hard for businesses to find the money they need, and it would be tricky for people to make their money grow. So, financial markets are a big part of keeping our economy going. The importance of financial markets in capital allocation and liquidity transfer: financial markets play a crucial role in allocating capital and matching those who have it with those who need it, while also facilitating short-term liquidity transfer. They attract funds from investors and channel them to businesses that use the capital to finance growth, from startup phases to expansion. Money markets allow firms to borrow funds on a short-term basis, while capital markets provide long-term funding for corporations to invest in physical capital goods. Without financial markets, it would be difficult for borrowers to find lenders. So simply, financial markets are super important because they help move money around and connect people who have it with people who need it. They'd also make it easy to get quick access to cash when needed. Here's how they work: 1. Investors put their money into these markets, and then the markets send the money to companies that want to grow, whether they're just starting out or expanding. 2. There are two types of markets: money markets help businesses get short-term loans, like when they need money quickly. Capital markets provide money for the long term, which businesses use to buy stuff like buildings and machines. 3. If there weren't financial markets, it would be really hard for people who need money to find people who are willing to lend it to them. Financial markets are super important because they help decide who gets money and who gives it. They're like matchmakers for people with money to invest and for businesses that need it to grow. They also make it easy to move money around quickly when needed. Financial markets gather money from people who want to invest, and then they give that money to businesses, whether they're just starting or growing bigger. There are two types of markets involved: money markets for short-term money borrowing and capital markets for long-term money for things like factories. Without financial markets, it would be really tough for those who need money to find people who can lend it. Financial markets revealing company value and facilitating complex transactions: financial markets provide feedback to management by showing demand for their company's stocks and the market's perception of their value. Complex transactions require markets where lenders and borrowers can meet, and existing commitments can be resolved. So simply, financial markets tell company leaders how much people want to buy their company's stocks and what the market thinks the company is worth. When people need to do tricky deals, they use these markets to find others who can lend them money or borrow from them, and even sell existing deals to others. This is important because financial markets let companies know how much people want to buy their stocks and what the market thinks their company is worth. Also, when deals get complicated and people need to borrow or lend money or sell existing deals, these markets are where they can make it happen. Financial markets are like a place where different financial needs can be sorted out and managed. Investor protection through information: the Securities Act of 1933. The Securities Act of 1933 ensures investors receive complete and accurate information before they invest. So simply, this law is crucial because it makes sure that people who want to invest in something get all the right and true information before they put their money in. It's like a shield for investors, helping them make better and safer choices with their money. Navigating securities registration requirements, exemptions, and limitations, the Securities Act requires securities registration, but it's more practical to consider registration of offers and sales. Many transactions are exempt from regulation. The Act applies to public offerings by issuers and underwriters, excluding private placements. Registration forms call for financial statements, management info, and securities details. Rule 144 permits restricted securities sales with issuer agreement, Form 144 filing, and a legal opinion. Resales are limited to 1% of stock outstanding or average weekly trading volume. So simply, the Securities Act says stocks need to be registered, but it's more about registering when stocks are being offered and sold. Some deals don't need regulation. The Act is for when companies sell stocks to the public with help from certain financial entities, not for private deals. When registering, companies must share financial statements, management information, and details about the stocks. Rule 144 lets people sell certain restricted stocks if the company agrees. They file Form 144 and get a legal opinion. But there are limits on how much can be sold, only a small percentage of the total stocks or the weekly trading volume. This is important because it talks about the rules for registering stocks. The law says stocks should be registered, especially when they're being offered and sold. However, some deals don't need this registration. It's about when companies sell stocks to the public, but not for private deals. When companies register, they need to share financial statements, management details, and information about the stocks. There's also a Rule 144, that lets people sell specific restricted stocks, but only if the company agrees. They complete Form 144 and get a legal opinion. There are limits on how much can be sold, only a small part of the total stocks or the weekly trading volume. This helps make sure that the sale of stocks is done fairly and responsibly. Regulating secondary trading, the Securities Exchange Act of 1934. The Securities Exchange Act of 1934 regulates the secondary trading of securities and their participants in the United States. So simply, this law manages how stocks are traded between people in the United States after they have already been issued by a company. This law sets the rules for how stocks are traded between people who aren't part of the company that issued the stocks. It also oversees the places where these trades happen and the different systems used for trading stocks. It's important because it helps ensure fair and organized trading in the stock market. Regulating securities trading, the Securities Exchange Act of 1934. The Securities Exchange Act of 1934 regulates the secondary trading of securities between persons often unrelated to the issuer, in most cases through brokers or dealers. It also regulates the actual securities exchanges, securities associations, and alternative trading systems. So simply, this law sets the rules for how stocks are traded between people who aren't part of the company that issued the stocks. It also oversees the places where these trades happen and the different systems used for trading stocks. It's important because it helps ensure fair and organized trading in the stock market. This is important because it sets rules for buying and selling stocks after they've been issued. It covers trades between people who aren't part of the company. The law also oversees the places where these trades happen and the systems used for trading stocks. It helps keep the stock market fair and working smoothly. Enhancing accountability and transparency, the impact of the Sarbanes-Oxley Act of 2002. The Sarbanes-Oxley Act of 2002 is a federal law that set new standards for public companies in the U.S. It aimed to increase accountability and transparency by imposing stricter financial governance laws. The law was a reaction to several corporate scandals, and it increased penalties for fraudulent financial activity. The law created an oversight board to regulate auditors and restricted auditing companies from providing non-audit services to the same clients. It also mandated enhanced reporting requirements for financial transactions and defined codes of conduct for securities analysts. So simply, the Sarbanes-Oxley Act of 2002 is a set of new rules for big companies in the U.S. It was made to make sure these companies are more responsible and clear about their money. This law happened because there were some big scams in companies. So to stop that, they made the rules stricter, the punishments harsher for lying about money. This is important because it stops companies from cheating with their money and makes sure they're more honest. The law makes companies follow stricter rules about their money and forces them to be clear about their finances. It also stops auditing companies from doing other jobs for the same company they check, so they stay fair. This law helps everyone trust big companies more and feel safer about how they use money. Enhancing corporate transparency and accountability, the impact of the Sarbanes-Oxley Act of 2002. The Sarbanes-Oxley Act of 2002 aimed to increase corporate transparency and accountability and introduce new penalties for corporate fraud and records tampering. It also required CEOs to sign off on corporate tax returns. So simply, boosting honest business practices, the importance of the Sarbanes-Oxley Act of 2002. This law was created to make companies more transparent and accountable. It introduced stricter punishments for cheating and messing with business records. Also, it made CEOs take responsibility by signing off on the company's tax papers. This is important because it helps make sure that companies are more honest about what they're doing. It also holds people in charge more responsible for any funny business that happens within the company. The act works to protect investors and keep businesses more trustworthy. Unveiling insider trading scheme, CEO and friend hit with SEC charges. The SEC charges a CEO and close friend with insider trading ahead of company sale, resulting in $164,260 in trading profits. So simply, revealing secret trading CEO and friend accused of cheating. This is important because it shows that the CEO and a friend are accused of using secret information to make money before the company was sold. Insider trading is illegal and unfair because it gives some people an advantage over others in the stock market. The SEC charges are significant as they aim to stop this kind of unfair behavior and maintain fairness in the market for everyone. Unveiling insider trading, a tale of Genentech's betrayal and SEC settlement. Redmond, a Genentech officer, shared confidential information about the company's sale with Signor-Astri, a restaurant manager. They both profited from insider trading and settled charges with the SEC for $324,000. Redmond agreed to be barred from serving as a public company officer for 5 years. So simply, a person named Redmond who worked at Genentech shared secret info about the company's sale with a restaurant manager called Signor-Astri. They both made money by trading based on this secret info. To resolve the problem, they paid $324,000 to the SEC. Also, Redmond won't be allowed to work as an officer in a public company for 5 years. This is important because it shows that someone from Genentech shared secret information about the company's sale with a restaurant manager, and they both made money by trading based on this secret info. They settled with the SEC by paying $324,000. It's a big deal because the person from Genentech is now not allowed to be an officer in a public company for 5 years as a punishment for what they did. This helps maintain fairness and trust in the business world.